In this, the 40th lesson in the course, A Critical History of Economic Theory and Policy, we examine the impact of debt on societies. How much debt is too much for the people and government of any society to carry before collapse occurs? This is a question people in many countries are being faced with today. We begin with a close examination of the world's most debt-ridden society, the United States of America. The population of the United States is aging, and younger adults are having fewer and fewer children. Yet household savings has fallen dramatically. In 2006, as the first of the baby boomers turned 60, personal savings was negative for the first time since the Great Depression. Most vulnerable to even minor financial setbacks were an estimated 35 million people categorized as poor by the U.S. government in 2009. In 2014, the number reached 46.7 million before beginning to come down. As recently as 2016, this number was still 40.6 million people, or 12.7% of the population. The crash in residential property markets also removed a significant portion of nominal household net worth. For some, the land they held recovered its market value over time. For others, the communities in which they live were so devastated that the land markets essentially collapsed and still have not recovered in 2018. The signs of worsening poverty are easy to see, even if there is debate over how to categorize people as living in poverty. A 2004 report published by the conservative-oriented Heritage Foundation made the argument that the poverty statistics fail to take account of many factors. For example, 46% of households labeled as poor are homeowners. 76% have air conditioning in their homes or apartments. A majority have more living space than the average enjoyed by residents in many European cities. A majority own one or more automobiles. Unstated is the extent to which such assets are subject to heavy debt loads, or what proportion of the population is living paycheck to paycheck, barely able to keep current on a mortgage loan, rental payments, or other credit obligations. A key variable in the cost of living for those with low incomes is the availability of income subsidies for decent housing or access to publicly owned housing. A study released in 2018 by the National Low-Income Housing Coalition reports that the U.S. has a shortage of more than 7.2 million rental units affordable and available to extremely low-income households. The need for income by millions of propertied households headed by seniors has created a market for reverse mortgages. Even as land values had been dropping, industry analysts calculated in 2007 that homeowners aged 62 or older held an estimated $4.3 trillion of property equity. Only a little more than 300,000 reverse mortgages had been originated to that point, representing less than 1% of market penetration. The demand for reverse mortgages continued to increase throughout the Obama presidency. However, recent changes in the program have resulted in a dramatic drop in volume in 2018. The relationship between access to credit and individual net worth is complex. For the majority of U.S. households, the ownership of a residential property is a primary source of personal net worth. Equity in the property tends to increase over time as mortgage loans are repaid and land values increase. CoreLogic reported that 2017 proved to be a very good year for property owners. the average homeowner gained $15,100 in property equity. Property prices in California and Washington state led the nation with $44,000 and $40,000 respectively. Moreover, the gradual lowering of purchasing power of currency means that one is repaying debt with currency that is, all other things being equal, easier to obtain than when the funds were originally borrowed. In periods when mortgage interest rates are falling, as they were beginning in the late 1980s, millions of property owners were able to refinance mortgage debt to lower the costs of servicing the debt and or significantly reduce the number of years before the loan was fully paid off. As one would expect, refinance volumes decline when mortgage interest rates remain relatively unchanged over several years. In 2004, Alan Greenspan, chairman of the Federal Reserve, looked back on the decade of low interest rates as a period during which millions of consumers benefited. He stated, "Indeed, the surge in mortgage refinancings likely improved rather than worsened the financial condition of the average homeowner. Some of the equity extracted through mortgage refinancing was used to pay down more expensive, non-tax deductible consumer debt, or used to make purchases that would otherwise have been financed by more expensive and less tax-favored credit. Indeed, the refinancing phenomenon has very likely been a supportive factor for the general economy." On the other hand, the legislation that eliminated the deductibility of interest payments on loans not collateralized by real estate opened the door for an explosion in the second mortgage lending arena, where consumers were frequently victimized by predatory lending terms. This was the market segment that triggered the financial crash in 2008, although the crash was on the way and would have occurred even if there had been no subprime mortgage loans made. Another important point to make is that low rates of interest on mortgage loans quickly increased demand for housing, which market forces capitalized into higher land prices. Home buyers were forced to take on higher levels of mortgage debt as property prices increased annually. For those individuals and households whose credit history was less than pristine, the market now offered financing options that ostensibly priced for the higher risk of defaults and loan losses. The so-called subprime mortgage market took off. Aggressive telemarketing, television and radio advertising, and internet marketing generated an explosion in the subprime mortgage market, from a 5.5% share in 1995 to 16.7% in 2007. A major concern of regulators turned out to be the high number of consumers qualified for conventional loan terms who were processed as subprime borrowers because mortgage brokers made more money doing so. A HUD analysis identified the serious consequences for the American society. Predatory mortgage lending practices strip borrowers of home equity and threaten families with foreclosure, destabilizing the very communities that are beginning to enjoy the fruits of our nation's economic success. Pressure to meet aggressive loan volume goals resulted in millions of loans made to borrowers who had minimum or no real ability for repayment. That said, analysts describe a collision of circumstances that caused the floodgate of defaults to open. It is not clear how many subprime borrowers were truly victimized by predatory lenders and how many simply had bad luck with risky loans they took on with open eyes. After short-term interest rates rose dramatically, starting in the summer of 2004, subprime loans reset with much larger payments. Meanwhile, the housing bubble burst and home prices began to fall, making it hard for subprime borrowers to refinance to better loans or sell their properties. Foreclosures have spiked. Unfortunately, referring to the downturn in property values as a housing bubble transfers the focus of analysts away from the dysfunctional nature of land markets under current law and tax policies. More attention must be given to the actual value of housing units separate from that of the underlying land parcels. For all but those housing units that have some historical significance and take on the character of a collectible, the value of a housing unit is best stated as its replacement cost less whatever depreciation must be recognized. What rises and falls in the property markets is the value of land. By the mid-2000s, so many regional property markets across the United States were under the severe stress of unaffordable land prices that a widespread collapse occurred at the end of the 18-year cycle. Neither businesses nor individuals could continue to absorb rising demands by landlords for higher rental fees. Rising delinquencies on predatory subprime mortgage loans were merely the tip of a giant iceberg. As delinquencies and then defaults mounted, some 50 subprime lending firms went bankrupt in just 6 months, from December 2006 to June 2007. David Cho of the Washington Post reported, "These companies specialized in subprime loans, generally offered to people with blemished credit or insufficient cash for a down payment. Subprime mortgages accounted for $600 billion, or about 20% of all new home loans in 2006. Foreclosures continued all across the United States. Nevada, Arizona, California, and Florida were among the hardest hit states, with metropolitan areas in California and Florida accounting for 9 of the top 10 areas with the highest rate of foreclosure. The situation took many years to stabilize, creating a growing population of homeless families and empty dwellings increasingly acquired by property companies and offered as rentals or flipped after making minimal repairs for a quick gain. Although the number of foreclosure filings has been falling since a March 2010 peak, the number is still well above what occurred prior to the property market crash. Foreclosure left cities and even entire neighborhoods plagued by vacant properties, often destroyed by departing owners or later vandalized. While these problems are not new, what is new is the speed with which the number of vacant properties escalated within previously stable neighborhoods. One housing analyst noted in 2008, 2.8% of all homes, excluding rental properties, were vacant during the first half of 2008. Regionally, 3.2% in the South, 1.9% the Northeast, 2.8% in the West. An analysis of vacant properties written by Elizabeth Duke, a member of the Board of Governors of the Federal Reserve System, described the scale of the problem as it stood back in 2011. The challenge for those trying to revitalize neighborhoods is to ensure that qualified homeowners and nonprofits are in a position to compete with investors for these now affordable homes, and the city and private sector have come together to achieve this goal. As of the first quarter of 2013, there were just over 133 million housing units in America, and 10.7% of them, more than 14.2 million, were vacant all year round for some reason or another. Fast forward to the second quarter of 2018, and the vacancy rate for rental housing was 6.8% and 1.5%, 1.4 million, for homeowner housing. The number of vacant residential properties increased in 81 of 149 metropolitan statistical areas analyzed in a 2018 study by Atom Data Solutions. Commenting on the extent of speculative construction that had driven property markets leading up to the 2008 crash, Christian Menegatti of RGE Monitor wrote, "There was a lot of reckless construction exploiting the fact that prices were going up. Suburban areas were flooded with new construction in locations that were commuter unfriendly. Now those are suffering the most." A more fundamental problem, of course, is the set of public policies that have contributed to the outward movement of people from the cities into the surrounding regions, requiring the construction and maintenance of a sprawling and aging infrastructure. Charles Heron, an engineer and planner, co-founder of a public interest group called Strong Towns, describes quite accurately what has occurred all across the United States. What we have found is that the underlying financing mechanisms of the suburban era, our post-World War II pattern of development, operates like a classic Ponzi scheme with ever-increasing rates of growth necessary to sustain long-term liabilities. Since the end of World War II, our cities and towns have experienced growth using three primary mechanisms: transfer payments between governments, where the federal or state government makes a direct investment in growth at the local level, such as funding a water or sewer system expansion; transportation spending, where transportation infrastructure is used to improve access to a site that can then be developed; public and private sector debt, where cities, developers, companies, and individuals take on debt as part of the development process, whether during construction or through the assumption of a mortgage. In each of these mechanisms, the local unit of government benefits from the enhanced revenues associated with new growth, but it also typically assumes the long-term liability for maintaining the new infrastructure. This exchange, a near-term cash advantage for a long-term financial obligation, is one element of a Ponzi scheme. And of course, every form of subsidy and transfer of costs benefits the owners of land, who experience rising land values without themselves having to incur any significant costs or risks associated with actual land development. What all this translated into was a society burdened by higher and higher levels of debt. For the 10 years ended 2007, household debt grew 152%. Household credit card debt grew by 75%. As consumers worked to pay down debt and banks tightened credit standards, total household debt fell from 2009 through 2013, but has now surpassed the previous high and as of mid-2018 has climbed to over $13 trillion. As of September 2018, the average household credit card debt in the United States was $9,300. Credit card holders paid banks $104 billion in credit card interest and fees during 2018, an increase of 11% over the previous year. Total credit card debt outstanding as of March 2018 was $1.027 trillion. Bankruptcy statistics for the period 2001 to 2017 are not easy to explain, however. Note the significant drop between 2005 and 2006, with the increase one would expect to see in 2008 and after until the recession began to lift. The national debt clock is a very public reminder of just how quickly the national debt has skyrocketed. Here it is in 2002 at $6.1 trillion. By March of 2006, the total was close to $8.2 trillion. By February of 2010, the debt passed $12.3 trillion. And by March 2011, the debt had climbed to $14.2 trillion. Move forward. On the 31st of December 2012, the debt stood at $16.3 trillion. And at the time this analysis was prepared, the debt had climbed to above $20 trillion. Total federal debt is increasing by over $3 billion daily. If the Fed continues to let interest rates increase, the revenue required to service the national debt could easily double. Global economic conditions have permitted the U.S. government to continue spending far above the revenue raised by taxation and other sources. The U.S. government has been the major beneficiary of continued purchase of government securities, despite a prolonged period of falling interest rates. As of June of 2018, the total foreign holdings came to $6.2 trillion. The Chinese were followed by the Japanese as the two largest holders of U.S. Treasury securities. At the same time, the household incomes of millions of seniors heavily dependent on interest from savings has fallen dramatically, requiring some to sell their long-time residential properties, obtain reverse mortgages in order to meet rising living costs, or drain savings. According to the U.S. Census Bureau, the poverty rate rose to 14.5% for people over 65 between 2015 and 2016. The statistics for women are even more sobering. Another serious concern is the level of debt incurred by the young in order to obtain a college education. Total student loan debt now exceeds $1.5 trillion, with a default rate of over 7%. The average student loan debt has now surpassed $37,100. The cost of tuition, room, and board has more than doubled since 1971. Attending a public university costs nearly $21,000 a year and $47,000 for a private nonprofit university. However, because many types of careers require a master's degree or other advanced education, millions of students incur far higher levels of debt by the time they complete their formal education. And finally, the level of mortgage debt owed on 1 to 4 family properties declined after 2008, but has again risen above $10 trillion to $10.646 trillion as of the first quarter of 2018. This debt is held by commercial and savings banks, insurance companies, government at all levels, Fannie Mae and Freddie Mac, the Federal Deposit Insurance Corporation, federal land banks, and private mortgage conduits. The Federal Deposit Insurance Corporation closed 465 failed banks from 2008 to 2012. Another 24 banks failed in 2013, and an additional 31 more between 2014 and 2017. The receivership of Washington Mutual Bank in 2008 was the largest bank failure in U.S. history. The gradual increases in mortgage interest rates over the last 5 years on a 30-year fixed-rate mortgage loan significantly reduced the number of homeowners seeking to refinance existing mortgage loans. As a consequence, a number of smaller banks and credit unions became insolvent and closed their doors. A part of the economy to watch closely is the sale of newly constructed homes, the supply of which has been low since the 2008 financial crisis. Consumer confidence in income and employment stability has generated renewed demand for larger and more amenity-rich properties selling for $300,000 or more. Over one half of all sales since September of 2016 have been for properties in this price range. One reason for the tight supply is that builders are breaking ground only when they have a buyer under contract approved for mortgage financing. And then there is the history of farmers and their problems with debt. Debt has always been a major concern for farmers. During periods of rising prices for food crops and other agricultural products, farmers borrow to acquire additional acreage at inflated asking prices. Then, when crop prices fall, they struggle to service the debt owed to the banks, and many end up in bankruptcy. And yet, the pattern repeats again and again. This is exactly the warning contained in a 2013 study by economists at the Federal Reserve Bank of Kansas City. They wrote, in 2013, historically high farm incomes are projected to keep U.S. farm debt and leverage low. Yet longer-term projections suggest that farm incomes could fall dramatically in 2014. If agriculture's historical wealth effect holds true, farm enterprises might use existing wealth to finance and smooth investment spending, sowing the seeds for another round of debt accumulation.